All right, well, let's take a look at the 2019 decision to loosen rules for mid-sized banks. That created a loophole that may have masked some recent losses from SVB. And moving forward, any decision to close that loophole could have some major impacts on regional banks. For more, we welcome in David Kass, University of Maryland finance professor. Good to have you on the show, David. So I first want to start with this loophole, because this is something that the regulators are considering here, something that they loosened, and it has to do with how banks report the losses on the securities they have on hold. Break that down for us and what this could mean then for regional banks.
Yes. First of all, thanks for having me. What the rule had been loosened earlier was for securities, long-term securities, for example, held by banks, long-term treasuries, mortgage-backed securities, if they had a loss, an unrealized loss in securities, and they were below a certain size in assets, they were not required to basically mark these securities to market, which would have resulted in a reduction in their capital and the capital buffer that they use and report to regulators and the public. And because they have this exemption, they received an exemption as a result of legislation in 2019, which was then enforced or implemented by the Federal Reserve. This loss, unrealized loss that they had, was pretty much hidden to some extent. And what proposals are being made now, both in Congress as well as at the Federal Reserve Board level, is to sort of increase the level of bank assets in which this reporting would be essentially marked to market, that these companies such as SVB, which incidentally at the end of 2022, its assets totaled $209 billion. It's sort of at the lower end of the mid-sized regional banks, but this would change the measurement of the unrealized capital gains, have it incorporated into their capital calculations, which would then make any losses, unrealized losses, certainly more visible to all.
So then if they were successful in closing this if they were successful in closing that loophole, then what would that look like in reality then for other regional banks?
Yeah, other regional banks right now, looking forward, what's being proposed now, other regional banks who are now with assets below $700 billion, one of the cutoffs, would now have to mark to market basically their unrealized losses in the long-term securities, which would reduce their capital. And this would basically reduce capital for such mid-sized or regional banks, such as U.S. Bancorp, Truist, Capital One, and PNC, to give examples looking forward.
So then, I mean, in the Wall Street Journal article, you said that one way of making banks safer for the whole economy, because obviously there was that concern about the contagion for the rest of the economy, was to ensure a larger capital buffer. How exactly do you do that, and who ends up footing the bill for that in the long run?
Well, this could be implemented by regulation and by Congress, and the implication of a larger capital buffer for banks, but it would be safer for the banks and the economy. It would be less likely that any bank would fail. But banks would basically be tightening up their lending standards. And there would be could be a possible credit crunch in the sense that smaller companies doing borrowing are more likely to go to smaller regional banks, especially those companies located outside of large cities, and they may find it harder to obtain loans and perhaps at higher interest rates than the case before. So the implication is there's a trade-off here. On the one hand, we'll have safer banks, less likely to fail, but on the other hand, the banks will sort of be being required to have more capital, a greater capital buffer, will be lending out or investing less money, and therefore their profits would probably decline over time. And that could, for example, result in a reduction of stock buybacks for shareholders of those companies. So certainly profitability might be expected to decline. And again, for the economy in general, it could be harder for smaller and mid-sized businesses to obtain loans going forward, which in turn would slow down the economy, although this would be working in parallel with what the Federal Reserve is trying to do to reduce the rate of inflation in the economy down to their target of 2%. So this slowdown or reduction in loan demand or loan availability would actually complement what the Federal Reserve is doing in this area.
And depending on how much we see that tightening with the credit crunch, could essentially act as another rate hike. A lot of people have been wondering about that. Now, as we look at the Fed's inflation targeting and we look ahead to some of big tech's earnings, then how does this picture play into how we might see that reflected in big tech earnings and equity markets? Then, being that we do have this convergence of issues at the moment.
Yes. Well, so far, what's interesting is so far, the large tech companies, the largest four are Apple by market capitalization, Apple, Amazon, Alphabet, and Microsoft have outperformed the market this year. For example, Apple and Amazon are up about 27% year to date, and Alphabet and the other one that's skipping my mind at the moment, have been up about 19%. And the overall market, NASDAQ has been up 15% year to date, the S&P 500 7%. So the leading tech companies have certainly outperformed the market, and they are forward-looking in their prices. But certainly with the Federal Reserve raising rates, reducing demand, this would put somewhat downward pressure on earnings of these companies. And this has led to layoffs at many of the large tech companies. And so there would be some reduction in profitability and profits in the near term. But I think long term, the outlook for the large tech companies is very good.